All right, let's talk taxes. You know that feeling, right? That annual crunch, maybe a bit overwhelming, or just wanting to be, well, smarter about your money.
Definitely. But what if tackling your taxes, especially as a small business owner or if you're self-employed, wasn't just about filing?
Exactly. What if it was actually about unlocking some pretty significant savings for your future?
It really can be. Your retirement plan, it's not just a nest egg for way down the road. It's potentially one of your best tax shields right now. We're talking strategic tax reduction, yeah.
And that's precisely our mission today on The Deep Dive. We're going to cut through all the jargon around retirement plan, specifically for small businesses and self-employed folks.
Our goal is simple. Find those tax-saving opportunities, maybe some surprising ones, and crucially, show you exactly how they link up with your 2024 tax forms.
Yeah, we'll guide you through the deductions, the credits, the contribution limits, all that good stuff.
And our main guide for this journey, it's IRS Publication 560, Retirement Plans for Small Business, the version for preparing 2024 returns.
Perfect. So get ready because we're about to see how these plans are seriously tax-favored ways to save. You can deduct contributions, watch earnings grow tax-free. It's pretty powerful.
Absolutely. Let's start with those core tax advantages. When the IRS says tax favored, what does that actually mean for, your wallet?
Good question. Break it down for us.
Okay, so it's kind of twofold. You get immediate tax savings and then long-term tax-free growth. First off, those contributions you make for your employees to a SEP, a simple, or a qualified plan.
Yeah.
Fully deductible, right off the top as a business expense that directly lowers your taxable business income.
Okay, so that's real money saved right
Yeah.
away. And if you're flying solo, sole proprietor, or maybe a partner in a partnership?
You get to deduct contributions for yourself, too. That's a big personal tax break, hitting your individual income tax directly.
Nice.
And get this, even things like trustee fees, the admin costs, they can sometimes be deductible, too, if contributions don't cover them.
Huh.
But the long-term play, the one people sometimes forget, the earnings on all these contributions, they generally grow completely tax-free until you actually take the money out in retirement.
Decades, potentially, of compound growth without the tax man taking a bite each year. That's huge.
It really is a powerful engine for building wealth.
Okay, now let's talk about something really exciting for immediate tax savings, the tax credits. Publication 560 highlights some big changes and reminders here.
Oh, yeah, this is where it gets really interesting. Let's start with the increased small employer pension plan startup cost credit. This is a big one.
Increased how?
Well, if you're an eligible employer, say 1 to 50 employees, the credit is now 100% of your qualified startup costs. It used to be 50%.
100%. Wow. So the government's basically paying you to set up a plan.
Pretty much.
What?
For businesses with 51 to 100 employees, it stays at 50%. But yeah, for smaller businesses, 100% credit, up to certain limits, of course, like the greater of $500 or the lesser of $250 per non-highly compensated employee or $5,000. It makes setting up a plan incredibly attractive.
That really lowers the barrier to entry, doesn't it? Makes it almost a no-brainer.
Exactly. And there's more, thanks to the Secure 2.0 Act. There's a new employer contributions credit.
Okay.
This is a credit based on a percentage of the contributions the employer makes, not the employee's elective deferrals, mind you. Another direct cut to your tax bill just for contributing to your employee's retirement.
More incentives. I like it.
And still rolling with Secure 2.0, there's the Small Employer Military Spouse Participation Credit. This targets employers who set up plans benefiting military spouses.
That's very specific. Good to see.
And another one, the Small Employer Automatic Enrollment Credit. If you add an automatic contribution feature to your plan, you can get a $500 credit per year for 3 years.
So you help your employees save automatically and you get a tax credit for it. Win-win.
You got it. And finally, one for the individuals, employees, and self-employed folks. The Retirement Savings Contributions Credit, or the Savers Credit.
Ah, yes. Heard of that one.
If you contribute to your plan, depending on your income, up to $2,000 of your contribution could be eligible for this credit. It's a dollar-for-dollar reduction of your tax liability. Check out Form 8880 for the details on that one.
So deductions reducing income, credits reducing the actual tax bill. Lots of layers of savings here.
Absolutely. Now, maybe we should quickly introduce the big 3 types of plans we're going to unpack today.
Let's do it.
Okay, first up, SEP Plans Simplified Employee Pension. As the name implies, very straightforward.
Yeah.
Contributions go into a SEP IRA.
Simple enough.
Then you have Simple Plans, Savings Incentive Match Plan for employees. Usually for businesses with 100 or fewer employees, these involve employee salary reductions and required employer contributions.
Okay, a bit more involved maybe.
A little. And finally, the qualified plans. These are often more complex but offer the most flexibility and potentially higher limits. Think 401k, profit sharing, even defined benefit plans, kind of the heavy hitters.
Got it. SEP, simple, qualified. Let's dive deep into SEPs first. Simplicity meets savings. What's the core idea here?
Okay, a SEP really is about simplicity. It's a written plan, lets an employer, even if that's just you, self-employed, contribute to retirement without all the administrative hassle of, say, a 401k.
And the money goes where?
Into a SEP IRA. It can be a traditional SEP IRA or, relatively new, a Roth SEP IRA. Each employee owns and controls their own IRA account. It's popular because it's just easier to set up and run.
Makes sense. Who gets to be in the plan? Are the eligibility rules tough?
They're pretty straightforward. Generally, an employee needs to be at least 21, have worked for you in at least 3 of the last 5 years, and have received at least $750 in compensation from you in 2024.
$750? That seems pretty low.
It is, and that $750 threshold stays the same for 2025. But here's the thing. As the employer, you can choose less restrictive rules, maybe let people in after just 1 year or with lower compensation. You just can't make it harder to get in than those baseline rules.
Okay, flexibility is good. How about setting one up? Is it a paperwork nightmare?
Not usually, no. You need a formal written agreement, but often you can just use the IRS model form, Form 5305 SEP.
5305 SEP.
Got it? If you use that model form, you generally don't even need prior IRS approval. Big time saver. You just keep the form for your records, give info to your employees.
And the deadline. Can I do this last minute for tax savings?
Actually, yes. The deadline to set up a SEP for a given year is the due date of your income tax return for that year, including extensions.
Wow, so I could set up a SEP for 2024, even in, say, March or April of 2025, as long as it's before I file my 2024 return.
Exactly. That offers some really nice late-stage tax planning flexibility.
Okay, let's hit the core tax savings. Contributions and deductions. What are the limits for 2024, and how does this show up on my tax forms?
Right, the important part. For contributions to an employee's SEP IRA in 2024, the limit is the lesser of 2 amounts, either 25% of their compensation or $69,000.
Okay, 25% or $69K.
And compensation itself is capped, right?
Yes, the amount of compensation you can consider for that calculation is capped at $345,000 for 2024. These limits tick up slightly for 2025 to $70,000 and $350,000. And crucially, for the employee, these contributions generally aren't taxable income when they go in.
Correct. They get the full contribution without an immediate tax hit.
Now, for the self-employed folks listening, sole proprietors, partners you mentioned, it's trickier to calculate their own contribution limit. Why is that?
Yes. This is a common point of confusion, but vital for tax savings. If you're self-employed, your compensation isn't just your gross profit from Schedule C.
Right.
It's your net earnings from self-employment. And this number is unique because you have to figure it after subtracting the deductible part of your self-employment tax and after subtracting the deduction for your own SEPI contribution.
Wait, so the amount I contribute affects the income number I use to calculate the contribution? That sounds circular?
It is. That's exactly why the IRS provides specific worksheets in Publication 560. You absolutely need to use those to figure out your maximum deductible contribution correctly. We'll dig into those worksheets later.
Good, because over-contributing sounds like a bad idea. Penalties.
Yep. Contribute more than the deduction limit. Those are excess contributions. They're not deductible, and you could face a 10% excise tax. So accuracy matters. Use the worksheets.
Got it. When do I actually take the deduction on my return?
Assuming your SP runs on a calendar year, you deduct contributions made for a calendar year on the tax return for that year. So contributions for 2024 get deducted on your 2024 return, even if you make the actual deposit in, say, February 2025 before filing.
Okay, the practical part. Where on the tax forms do these deductions go? Let's nail this down for maximum tax saving.
Super important. Contributions for your regular W-2 employees. If you're a sole proprietor, that's a business expense on Schedule C, Form 1040, or Schedule F if you're a farmer.
Okay.
Partnerships deducted on Form 1065. Corporations use Form 1120 or 1120S. This directly reduces your business's taxable profit.
But contributions for yourself as a sole proprietor or partner, that's different, right? This is key for personal tax reduction.
Precisely. This trips people up, but it's a powerful tax saver. You don't deduct your own SP contribution on Schedule C or F. No.
Where then?
It goes directly on Schedule 1, Form 1040, line 16. It's an above-the-line deduction.
Line 16, Schedule 1. Got it. And for partners?
Partners will see their share of the contribution reported on the Schedule K1 they get from the partnership. They then take that number and put it on line 16 of their personal Schedule 1.
So it reduces your adjusted gross income, which can affect eligibility for other deductions and credits, too. Powerful stuff.
Exactly. Now, quickly on SARSEPs, those salary reduction SEPs.
Yeah. Can you still start one?
Nope, can't set up new ones after 1996. But if you have one grandfathered in, it can continue. Participants can still make elective deferrals.
Okay. And those have contribution limits, too.
They do, subject to special non-discrimination tests like the ADP test. The limit for elective deferrals in a SARSEP for 2024 is $23,000 plus a $7,500 catch-up if you're 50 or older. These limits coordinate with 401k limits.
And reporting for SFPs, where does it show up?
Yeah. Generally, employer contributions to a traditional SEP IRA don't go on the employee's W-2 unless it's a SARSEP deferral. Roth SEP contributions, however, are reported differently, often involving the W-2 for salary reduction and maybe a 1099-R for employer contributions. The plan provider usually handles the specifics.
Okay, good overview of SEPs. Let's move to simple plans. A smart choice for small employers. How do these differ?
Simple plans are also simplified, but the key difference is they require both employee salary reductions and mandatory employer contributions. They're generally for employers with 100 or fewer employees who earned $5,000 or more in the prior year.
And you said it usually has to be your only plan.
That's a crucial point, yes. Generally, if you have a simple plan, you can't maintain another qualified plan, SEP or 403B, for the same employees with very limited exceptions. So it's often an either choice.
How does participation work? Similar eligibility.
Similar but different threshold. Any employee who's expected to get at least $5,000 in compensation in the current year and earned at least $5,000 in any 2 preceding years is generally eligible. And remember, employee includes you if you're self-employed.
2 preceding years.
Okay.
And you could be less restrictive here, too.
Yes, you can always choose to let employees participate sooner or with less compensation.
Setting up a simple IRA plan straightforward like a SEP.
Pretty much. You use specific IRS forms, 5304 Simple or 5305 Simple. The setup window is usually January 1st to October 1st for an existing business, and you have to notify employees before their election period, which is typically November 2 to December 31.
Right, contributions, employee salary reductions, and that mandatory employer part. Key tax savings here, I bet.
Definitely. Employees can generally choose to defer up to $16,000 of their pay for 2024. That goes up to $16,500 for 2025.
$16,000. And catch up for older workers?
Yes. Age 50 plus can add another $3,500 generally for 2024-2025. Now, under Secure 2.0, there are potentially higher limits for both regular and catch-up contributions for certain employers, but the general limits are $16K and $3.05K.
And the employer must contribute something.
Yes, this is mandatory. You have 2 main choices. Option 1, matching contributions. Typically, you match employee deferrals dollar for dollar up to 3% of their compensation.
Okay, match up to 3%.
You can temporarily reduce that match down to 1%, but not for more than 2 years in any 5-year period.
Or option 2.
Option 2 is non-elective contributions. Here, you contribute 2% of compensation for each eligible employee, whether they defer salary or not, as long as they earn at least $5,000 or less if you choose.
So 3% match or 2% for everyone, and Secure 2.0 added something here too.
It did. It allows for additional non-elective contributions on top of the required ones, up to 10% of compensation, capped at $5,000 for 2024.
And all these employer contributions are deductible for the business.
Absolutely. A direct tax deduction while boosting employee savings.
Where do these deductions go on the form? Same as SOPs.
Pretty much, yes. Employer contributions for employees go on Schedule CF, Form N65, or Form 112-011-20S. And just like SEPs, contributions for yourself as a sole proprietor or partner.
Let me guess. Schedule 1, line 16.
You got it. Line 16 of Schedule 1, Form 1040, for your own contributions.
And reporting on W-2s.
Employee salary reductions to a traditional simple IRA, not subject to income tax withholding, but they are subject to Social Security, Medicare, FUTA taxes. Reported in Box 12 of the W-2. Roth simple contributions are taxable upfront and also reported. Employer contributions usually aren't on the W-2.
Okay. And briefly, simple 401k, are they common?
Less common than simple IRAs, but they exist. They're an alternative also for employers with 100 or fewer employees. They follow 401k rules generally, but have specific contribution vesting requirements to let them bypass some complex non-discrimination testing. A simpler 401k, basically.
Got it. Now let's unpack the big ones. Qualified plans, 401k, profit sharing, etc. What makes these different and potentially more powerful tax-wise?
Qualified plans offer the most design flexibility and often, though not always, the highest contribution potential. They share the core tax benefits, deductible employer contributions, tax-deferred growth.
What are the main types under this umbrella?
Two broad categories, defined contribution, DC, and defined benefit, DB.
DC and DB. Okay.
DC plans have individual accounts. Your benefit depends on contributions plus earnings. Think profit-sharing plans where employer contributions can be discretionary year to year, giving you flexibility, or money purchase pension plans, which require fixed mandatory contributions. And of course, the popular 401k is a type of DC plan, often part of a profit-sharing plan.
And defined benefit.
TB plans are different. They promise a specific benefit amount at retirement, like an annuity. Contributions are calculated by actuaries to ensure the plan can meet those future promises. Much more complex, usually needs professional help to run.
Why is that qualified status so important for taxes? What rules do you need to follow?
That status unlocks the tax benefits. To keep it, plans must follow IRS rules on non-discrimination, basically, ensuring the plan doesn't unfairly favor highly compensated employees over rank-and-file workers.
Okay, fairness rules.
Right. Also, vesting rules, which determine when the employer contributions become irrevocably yours, even if you leave. And participation rules generally, employees age 21 plus with 1 year of service must be allowed in. There are some changes coming for 401ks to shorten that service requirement, too.
What about the contribution limits for these? Are they higher?
For defined contribution plans, the limit on total annual additions, employer contributions, employee contributions, forfeitures is the lesser of 100% of compensation or $69,000 for 2024. That's the same overall limit as SEPs.
69K again. And defined benefit.
DB limits are based on the benefit paid out, not the contribution. The maximum annual benefit is the lesser of 100% of your average highest 3 years pay, or $275,000 for 2024. The contributions needed to fund that can sometimes be quite large, especially for older owners.
Let's zoom in on the 401k and elective deferrals.
Yeah.
It's a huge tax saver for employees, right? Pre-tax savings.
Absolutely huge. Elective deferrals let participants' employees and the self-employed owner contribute money before income taxes are taken out. Immediate tax reduction on your paycheck.
What's the limit for 2024?
The general limit is $23,000 for 2024. Goes up to $23,500 for 2025. And remember, this limit applies across all plans you might participate in, like if you have 2 jobs with 401k.
23,000. Plus, catch up for the 50 and over crowd.
Yes. An additional $7,500 catch-up contribution is allowed for both 2024 and 2025. So someone 50 or older could potentially defer $30,500 in 2024. That's significant tax deferral.
We mentioned automatic enrollment earlier. How does that help the employer, tax-wise or otherwise?
It helps boost participation, which is great. Features like QACAs, qualified automatic contribution arrangements, can give a plan safe harbor status.
Safe harbor.
Meaning it can automatically pass some of those tricky non-discrimination tests, reducing administrative burden and compliance risk for the employer. Plus, there's that potential $500 annual tax credit for starting an auto-enrollment feature.
And Roth contributions within a 401k. How does that tax strategy work?
The Roth 401k option. It's the mirror image of traditional deferrals. You contribute after-tax dollars, so no upfront deduction.
Okay, pay tax now.
But the huge payoff comes later. If you follow the rules, all your qualified distributions in retirement, your contributions, and all the earnings are completely tax-free.
Tax-free growth and tax-free withdrawals. That's powerful long-term tax planning.
Incredibly powerful, especially if you think you might be in a higher tax bracket down the road.
Now, the employer deduction for these qualified plans. How much can the business deduct?
Generally, employer contributions are deductible. For defined contribution plans, like profit sharing or 401k employer matches, the maximum deduction is typically limited to 25% of the total compensation paid to all eligible participating employees.
25% of payroll.
Okay. And again, for the self-employed owner's own contribution, back to those special worksheets we keep mentioning.
Right, the circular calculation. We'll get there. What if the business contributes too much? More than the deduction limit?
That's a non-deductible contribution. You might be able to carry it forward and deduct it in a future year subject to limits. But importantly, there's potentially a 10% excise tax on those non-deductible amounts. You'd report and pay that on Form 5330. So you want to avoid that.
How does reporting work on the W-2 for 401k?
Traditional pre-tax deferrals, they reduce Box 1 wages, taxable income, but are still included in Box 3 and 5, Social Security Medicare wages. They show up in Box 12 with a code, usually D.
And Roth 401k deferrals.
Since they're after tax, they don't reduce Box 1 wages. They're included in Boxes 1, 3, and 5 and reported in Box 12 with an AA or BB. Distributions later come out on Form 1099-R.
Okay, distributions. What if you need the money before retirement age, say 59 and a half? That 10% penalty always applies. Avoiding penalties is a tax saving too.
Great question and very practical. While the 10% early withdrawal penalty is the general rule, the IRS actually provides a lot of exceptions. It shows some flexibility for real-life situations.
Like what? Give us some common examples.
Okay, the penalty usually doesn't apply if the withdrawal is due to death or total and permanent disability. Also, if you separate from service with that employer in or after the year you turn 55.
Age 55 separation, okay.
Distributions made under a QDRO, that's a Qualified Domestic Relations Order, usually from a divorce, are exempt. Withdrawals to pay for certain medical expenses exceeding a threshold are also exempt.
Are there newer exceptions too?
Yes, Congress has added more over time. Things like qualified reservist distributions, up to $5,000 for a qualified birth or adoption, up to $10,000 for victims of domestic abuse, even up to $1,000 a year for certain emergency personal expenses.
Wow. And education or first home?
Those too, potentially. Withdrawals for higher education expenses and up to $10,000 lifetime for a first-time home purchase from an IRA. Rules can differ slightly for 401ks, often requiring a loan provision rather than withdrawal. The point is, always check the exceptions before assuming you'll pay the penalty.
Absolutely critical point. Don't just assume the penalty applies. Check Publication 560 or talk to a pro. What about RMDs?
Right. Required minimum distributions. You generally have to start taking money out by April 1st of the year after you turn 73 or after you retire. If that's later, unless you're 5% owner, then it's usually age 73 regardless of retirement.
And rollovers. Easy to do tax-free.
Yes, rollovers to another eligible plan or IRA are generally tax-free, but definitely do a direct rollover from plan to plan or plan to IRA. If they cut you a check, they usually have to withhold 20% for taxes, which you then have to make up when you deposit it to avoid tax issues. Direct is cleaner.
Okay, let's tackle it head on. The Self-Employed Tax Toolkit. Worksheets for your deduction. That circular calculation we keep mentioning for SEPs and qualified plans. Break down the strategy here.
Okay, this is where the rubber meets the road for maximizing your personal tax deduction as a sole proprietor or partner. The core issue, again, is your compensation for calculating your own retirement contribution limit.
It's not just your profit.
Right. It's your net earnings from self-employment after you subtract 1/2 of your self-employment tax and after you subtract your own retirement plan contribution. That last part makes it circular.
So how do we break the circle?
The IRS gives us the tools in Publication 560, a rate table, a rate worksheet, and the main deduction worksheet for self-employed.
Do we need to go line by line through that worksheet? That might be tough to follow just listening.
Agreed. Let's focus on the key concepts and the outcome. First big aha moment. Your starting point on the worksheet isn't your gross business profit, it's your net profit from Schedule C or F.
Okay, net profit.
Then, step 2 is crucial. Subtract the deduction for 1/2 of your self-employment tax. You find that amount on Schedule 1, Form 1040, line 15.
Right, that deduction everyone gets.
That gives you step 3, your actual net earnings from self-employment adjusted for SE tax. This is the base number that retirement contributions are figured on, and it's always lower than your Schedule C profit.
So if I made $200K net profit, my contribution base is something less than $200. That's important.
Critically important. Many people mess that up. Now, because your contribution also reduces this base, you can't just apply your plan's stated contribution rate, like 10% or 20%, directly to that adjusted number.
Why not?
Because it would be based on a number that doesn't yet reflect the contribution deduction itself. So the IRS worksheets help you calculate a reduced rate specifically for yourself. For example, a 25% plan contribution rate effectively becomes a 20% rate when applied to your adjusted net earnings for calculating your own contribution. A 15% rate becomes 13.0435%, and so on.
Ah, okay. So the worksheet adjusts the rate to account for the circular calculation.
Clever. Exactly. You find your adjusted rate using the rate table or rate worksheet, then multiply your adjusted net earnings, step 3, by this reduced rates rate, step 4. That gives you a preliminary contribution amount, step 5.
Then you just check it against the overall limits.
Right. You compare that amount against the compensation limit calculation, step 6, and the overall dollar limit, like $69,000 for DC plans in 2024. Step 8, if you also made elective deferrals, those get factored in too.
And the final result of all this worksheet magic.
You land on step 21, your maximum deductible contribution for yourself. This number is gold.
And where does this golden number go on the tax return, the payoff?
This number, your actual contribution up to this calculated maximum, goes directly onto Schedule 1, Form 1040, line 16.
Line 16 again. That's the direct path from these complex calculations to real tangible tax savings on your personal return. Reduces your AGI.
Fantastic. That's a connection. It turns that confusing calculation into a clear tax-saving action.
Perfect explanation. That really clarifies the why and the where. What about basic reporting like Form 5500? Do solo plans need to file?
Good point. Generally, one participant plans just you, or you and your spouse only need to file Form 5500 EZ, or maybe 5500 SF, if the total plan assets exceed $250,000 at the end of the plan year. Under that, no annual filing is usually required until the final year of the plan.
Okay, good threshold to know. Phew, we have covered a ton of ground today.
We really have, but it shows just how many opportunities there are.
Absolutely. It's crystal clear that understanding these retirement plans, SFPs, simples, qualified plans, is about way more than just saving. It's about smart tax strategy. Immediate deductions, tax credits, tax-free growth.
It really connects directly to your tax return year after year. For small business owners, for the self-employed, this isn't just a nice to have. A well-chosen, well-funded retirement plan is honestly one of the most significant tax-saving tools you have at your disposal.
So the question for everyone listening is, are you making your money work as hard for you tax-wise as you work for your business?
It's worth thinking about. Maybe reevaluate your current setup, or if you don't have one, look into starting one. Talk to a qualified tax professional or financial advisor.
Definitely. They can help you figure out the best fit for your specific situation and maximize these opportunities. Remember, the IRS puts out Publication 560 for a reason. These benefits are there for you to use.
Use them wisely.